All right, Tom, welcome back to the program, my friend. How have you been?
I've been good, Jerry. It's been a great week. Glad to be back.
We have been talking about diamonds at length this morning, and I'm looking over all of the points that we put together. We did quite a bit of research. We put out the article this morning on all the different reasons why diamonds could be well positioned to go higher, even higher than they already have been over the last several years, because of this new IDEX ETF that's, we're not sure if it's going to come out. It's looking likely. What's your take on this whole thing? You've been in the diamond business for, 35 years? I mean, you've been doing this.
I started diamonds in 1975, actually 2 years before
you started gold.
Got in the gold and silver business.
So you know this better than most. Yeah, what do you think?
Well, I think it's always, when you have an SEC product, Securities Exchange Commission, that has to look at it and evaluate it, you sure can't pass judgment. But the buzz in the diamond industry on the people that actually cut and supply and buy the diamonds uncut, what they call the site, SITE, comes out 10 times a year. They're all very, very excited about it. And the top end of the white diamond market in 1 carat stones has certainly proven that with the jump in the first quarter for people that, do believe that the ETF will happen, and they're willing to take a chance and buy the diamonds, because if the ETF did not happen, the diamonds would be a good investment.
Yeah, and if we look back at just a chart of diamond prices over the last several years, all the data that I'm showing shows, and of course, there has to be some sort of caveat, and perhaps you can help me understand this, but ever since 1959, it says that diamond prices have increased an average of 15% per year. Now, how do they go about calculating that? Because it's not a liquid market like a normal commodity on the commodities exchange.
This is a great question, and this is an answer that everybody should ingrain in their mind. De Beers was a monopoly, and they settled with the United States antitrust laws about 5 years ago and paid a fine for being a monopoly and monopolizing the diamond industry worldwide. But now De Beers has retail shops in the United States and is not monopolizing. So here's how they got those returns, and this is important, people, because it's kind of like buying numismatic coins. When they would take the rough material to the site in England 10 times a year, and they would look at what the comparable rough diamond sold for in January and what it sold for at the end of December, and they would say, okay, it went up 12%. It was a real return. But it was a real return within the people cutting it. Once the diamond got cut and got into the market, if a wholesaler was selling it to someone directly, or if a retail diamond store was selling it to somebody directly, it had a lot larger markup on it. So, if someone bought it from a wholesaler, those figures would be right. But just like a numismatic coin, if somebody bought it from a telemarketing firm and paid a 30 or 40, 50% commission, then it takes them several years to get even. So that's important that people realize those are real numbers, Jerry. Those are what the rough diamond market increased all those years back when De Beers was pretty much running a monopoly. But if you notice, since the monopoly was broken a few years ago, the returns have actually been higher and the markups have come down. It's looking more and more like an investment product every day.
It's so ironic as the people in America begin to wake up to the fact that we are just crumbling with our economy and, of course, all the garbage that's happening in Washington and the overspending and the overconsumption, and people are turning to alternative investments en masse. Of course, they've looked at gold, they've looked at silver, they've driven prices up, of course, through the ETFs, and we expect gold and silver just to continue rising, not because it's in a bubble, but because people are in search of real money. But diamonds are not something that people tend to think about as an investment. In fact, around the world, it seems as if, Tom, that they're mainly and predominantly used for industrial uses because they have tremendous industrial uses. But it looks like, I'm looking at a report here from Bain and Company, and they're saying that diamond demand in carats will rise more than 6% every single year all the way through 2020, and the supply of that is only going to be less than 3%. and so it's going to outpace the supply. Is that demand, is that coming from investment demand, or is that coming from industrial demand? How do they calculate that?
Well, the industrial demand is really a different animal now. It does count as carrots sold and all that at very low prices, but and they're calculating the growth based on sales, imports, because there are records of imports when diamonds are brought into the United States to be cut or brought into China or Abdal Oberstein in Germany. So the numbers are very reliable as you see the demand go up, and certainly I would agree with that study that we're seeing demand outstrip the supply, but it's for different reasons. It not only because the investment is growing because of what's going on in China and India, but also because of people like the United States who are afraid their gold's going to be confiscated. They're now diversifying into diamonds. I look at my larger clients, and almost every one of them have bought diamonds to have something portable that they could leave the country and cash in anywhere in the world. It's a very liquid product, and boy, you talk about condensed thing. You could put these in a mountain and wear them out of the country. You carry $1 million worth in your pocket and never even show up in a detection device. So we see a lot of investors moving to diamonds here as diversification, not only as an investment because of the demand that's created worldwide, but also for confidentiality and portability. And certainly with the estate tax and the Bush cuts talking about ending again later in the year, the Congress and Senate will have to deal with that issue again. And there are a lot of people that just want to have their assets confidential. So all this is driving the diamond prices, and it really is picking up momentum all the time. It's taking me much more time to source diamonds. It takes me 3 times the amount of time to source diamonds it used to take. I've got 3 diamonds this week I've worked on since Monday and still have not got the exact thing the clients want.
Interesting, because the supply is just thinning out.
It's really thinning out, and it's really thinning out in 2 areas in particular, and that's the 1 carat DEFG color VVS1 to VS1 that will be used in the ETFs if they are approved. And then the second area is the yellow diamonds that are still underpriced. But those are the 2 areas that the market is really, really thinning out.
So when the investors piled into the gold ETFs, of course, it drove prices up because those were technically supposed to be backed with physical gold, although we know that there's a bunch of debate about that. But with the IDEX ETF, they're going to be backing this up apparently with those, as you mentioned, the 1 carat investment grade diamonds. And I would imagine that many stockbrokers out there, many investment firms are going to gravitate towards this ETF if it does indeed get passed by the SEC. This, of course, could have a dramatic effect on diamond prices, no?
Well, absolutely, Jerry. You're talking about a thin market. You just put a few $1 million into it, it's going to have that fund jumping right out of the blocks. There's no question. And as I tell my clients that ask me, all they're doing is buying something as inventory for that ETF in the future if the ETF is approved. So, yeah, you got to look as thinly traded as diamonds are and to put that kind of pressure. And it's been very interesting. When I first sent out an email about this ETF coming, I had several brokerage firms call me that, you're just seeing brokers now more and more realizing they've got to diversify their clients' portfolios. And whether they're buying physical gold or physical diamonds or put them in ETFs, they still see the need to it. And really, when you get down to it, each investor is going to make his own decision whether he wants an ETF or whether he wants it in his hand. So it's real exciting, a very exciting time for us to have been around the diamond industry all these years. But the answer to your question is, oh, yes, no question. Just a few $1 million could send diamonds up 15 to 25% very quickly.
Wow. And the folks who obviously pile into the ETF are going to miss, I would imagine, the lion's share of that early run. Of course, owning the physical diamonds themselves, as you mentioned, the portability, the estate tax benefits that are potentially there. There's just all kinds of reasons to hold the physical diamond itself. When you talk to an investor, how much of a particular portfolio do you think that people should consider for physical diamonds?
Well, I mean, I've been around so long and traveled the world and spoken all over the world so many years. I look at things a little bit different than the average person. I like 5% in diamonds, and then 25 to 35 in precious metals. Even the Aden sisters in their newsletter last week has now got 40% into precious metals. These is the top newsletter in the world, saying you put 40% into precious metals. So I like 40%, but I like about 5% in diamonds and about 35% in precious metals. And somebody said, well, that's a little aggressive for me. Well, that's fine. Just put 2% of your portfolio in there. But I definitely think it's a great, solid place to diversify with very, very, very little downside risk.
We got a call the other day from an advisor who said, I like Tom's advice, and I'd like to be able to send someone to him in the event that, one of my clients wants to buy diamonds or gold or silver. And I don't think we've ever really talked about that, but you do work with advisors all over the country.
Oh, my gosh, yes. That's been a big part of my business for the last 30 years. I mean, I had a brokerage firm this morning. I mean, literally here on Friday afternoon late this morning, I was on the phone with a brokerage firm in North Carolina quite a while. They wanted to send clients to me both for gold and diamonds. So, it just happens all the time because they can't do the physical. They can put their clients into ETFs or gold mining shares, but they cannot put them into physical delivered gold, silver, or diamonds. So I get a lot of that because a lot of investors out there want material in their hands.
Well, if they'd like to contact you about that, or if we have listeners who are saying, I'd like to talk to Tom about physical diamonds, or I'm a broker or an insurance agent, or I'm in the financial world and I'd like to be able to refer people to Tom, how do they contact you?
Well, just give me a call at 800-247-2812, 800-247-2812. And if there's anybody out there listening that's not getting my email blasts that go out 3 or 4 times, 2 to 4 times a week, they can just go to ftmdaily.com and hit the precious metals button and sign up. We don't sell our list to anybody. No one sees it. It's completely confidential, and we'll send out economic news, news on specials, timing advice on getting in and out of the precious metals, and there is no cost. So if any of the listeners want to sign up, just let them go to ftmdaily.com and hit that precious metals button and sign up.
All right, Tom. Well, we'll be back next week with our regular precious metals market update. I know that there's been a lot of things happening in gold and silver. We'll get to those next week. But for now, thank you so much for coming on. I hope you have a wonderful weekend.
You too, Jerry. Always a pleasure.